The Nasdaq every single day this week, Monday, Tuesday, Wednesday, Thursday, positive on the Nasdaq. 4-day winning streak, and on the week so far, the Nasdaq 100 up around about 6%. Can we add to those gains? On the S&P 500 futures, trying to stage a recovery here, going into the cash open, we're down about 1/3 of 1%. As the opening bow, switch at the board and get to the bond market. Yields look like this on a 10-year, down 10 basis points. Your yield right now, 347.34 at the front end of the curve. I've said it all week. The 2-year trading like a penny stock. The 2-year right now in America on the Treasury yield curve, we are down by about 9 basis points to 4.06%. Elsewhere in the FX market, Lagarde went 50. Powell will go who knows where. Euro dollar 106.29, we're positive 0.2 of 1%, and crude has had a really tough week this week. South of 70, 67.87 on WTI. We're down about 0.7 of 1%. We are about 30 seconds into the session. Your equity market looks a little something like this. We are negative 0.2 of 1% on the S&P, and just about lower on the Nasdaq too. On the Nasdaq Composite, down about 0.1 of 1%. One stock to watch at the open, it's First Republic, a $30 billion deposit injection from the biggest banks on Wall Street, failing to lift sentiment. Shares back down by 16 or 17%. Sonali Basak, this has been a tough week for this bank.
It certainly has, and it regards the end game of this bank as well. On one good hand that you're seeing here, John, is the flight to deposits from the big banks over to First Republic helps shore up the confidence a little bit here. But there's still questions about whether this gets sold at the end and what that means for shareholders and bondholders. Remember, I think the bond action here is really interesting, falling below 60 cents on the dollar, back above, under pressure now as well as the equity. Remember, these bondholders are hoping for a sale at the end of the day. You also just have to watch how clients are moving also. I wanted to take a look at Schwab here as well. Sometimes it's a question about viability at the end of the day. Sometimes it's just a question about profitability. You have massive flows here from prime money market funds to government securities here. So that risk appetite of clients as well makes a big difference for a lot of these firms beyond that deposit flight.
Sonali, you've brought up a really good point. It's about the profit challenge now, not just for that bank, but perhaps the whole sector, and maybe the line between the regionals and the big ones here on Wall Street.
Yeah, I mean, I've never had more intensity, John, around an earnings season, because another big question here is where their deposits are going, how much they're fleeing the smaller ones, and what it means for the big ones. I think we won't get a full answer to that. I was in a bank this week, asked for a number on deposits. He said, I can't tell you because they're coming in so fast and hard. That means they've got to be taken out of somewhere else.
Sonali, I think we know a few of those names, don't we? Thank you. First Republic right now down about 16%. The broader banking sector following suit. A string of bank failures dragging the KBW Bank Index down 20% in 1 week, casting a shadow over the entire industry. The turmoil continuing to spread through lenders big and small. Abby has more. Hey, Abby.
Hey, John. Well, it really is incredible, and I would argue that it's exactly what you've been talking about this morning, a crisis in confidence. Yes, yesterday that backstop for First Republic tied it up a little bit with those stocks rallying yesterday, but the fact that you have these stocks down big time again today suggests that investors don't think that it's over, that some of these banks could in fact go the way of Silicon Valley Bank, or to Sonali's point that you were just talking about, the profit outlook. So you do have that KRE down once again. Big declines, down about 30% over the last 15 days, down 12 of those 15 days. And you can see that PacWest, Western Alliance, really doing the same thing. Now, we of course have the big banks backstopping the smaller banks, and those big banks such as JP Morgan, Citi, Bank of America last year forced to take these mark-to-market losses through regulatory capital. So they're down less. You can see the dramatic divergence over the last year. And it's not all bad, John. We do have the KRE again down sharply from its recent highs. That means some investors are trying to bottom fish. If we go into the Bloomberg terminal, we will see the inflows on the KRE. Well, I was looking all the way back to the banking crisis, or I should say the GFC, the financial crisis. These are record inflows right now, John, for the KRE.
Abby, thank you. What's the market check without Credit Suisse in the mix? That stock down by 8.6%, 185. Lower the session, 176, a break of 80. Again, a little bit earlier. A fresh dose of liquidity failing to put concerns over the bank's fate to bed. The stock heading for its worst weekly drop in 3 years. Ollie Crook has been staying close for us through the hour over in Zurich. Ollie, thanks for being with us, mate. Let's go through it. UBS does not want to dance, does it?
That's right, Jonathan. And really, the question is, it's the same question as yesterday, is how much runway does 50 billion francs buy you? And we turn to the market to try to answer that question. We see the shares down up to 11% today. You really don't want to see that if you're in the building behind me, 36 hours after that huge liquidity injection. And this invariably asks the question of what is the future of this bank? That invariably brings up this question of the tie-up with UBS and Credit Suisse. And invariably, it brings up all of the other issues that brings up, antitrust issues, the client base, and all these other reasons that, you know, that it may or may not make sense. And in many ways, it does not make sense. They do not want this. But here the question is for me, John, after the 3 days that Credit Suisse has just had, how much of that business is UBS going to get for free?
That's a big question, and it's a similar question to what we've been asking here on Wall Street for some of the big players with deposit outflows migrating towards them. Ollie, thank you, mate, for that. Credit Suisse lower over in Swiss trading right now. Credit Suisse is down by 9%. First Republic is down by close to 21%. Jack, I want to come to you on this. Ollie, our colleague there, just went through everything that's happened this week with Credit Suisse. They've tapped the S&P for liquidity, 50 billion Swiss. We've seen 11 banks in America come together, deposit 30 billion at one institution here, and yet here we are staring at prices lower, aggressively so. Jack, what does it take right now to instill confidence?
John, I mean, that's a really hard question to answer because so much has already been done. You know, this feels like, to me, almost like a landslide here in terms of sentiment. People just not wanting to be the last ones out. Now, I do think it is important to draw a distinction here. Are you worried about the shareholders or are you worried about the depositors? And when you're looking at these institutions, whether they're here in the United States or overseas, the quality of these banks still seems to be reasonably high enough that depositors probably don't have a whole lot to worry about, especially when you consider what the Swiss National Bank has done, what Lagarde said in her press conference yesterday, what the Federal Reserve did alongside the FDIC and Treasury over the weekend. But shareholders, I think, are in for a bumpy ride, at least for a little while longer, as the sentiment kind of gets sorted out around here and we find a bottom.
Brian, you say you are tactically defensive. What is that? And is defensive only in the NASDAQ at the moment?
Yeah, I mean, we started to see market sentiment deteriorate towards the end of February, and by that I mean you see credit spreads moving up a bit. The dollar got a bit stronger, so it was clear that the market was getting beyond its soft landing hopes and starting to think about below trend and weakening growth again. And so for us, that's a tactical shift to be more defensive. And when you're more defensive, certainly an increase of an exposure to fixed income away from credit towards higher quality bonds, but also moving up in size and shifting more away from value and cyclicals to growth and defensive. And so, you know, it's been interesting what's been going on in the NASDAQ. Certainly the NASDAQ stocks, many of which were hated last year, are being viewed as more of a defensive position here. And they're getting the benefit of lower interest rates, which we've seen across the yield curve. And, you know, this idea that prior to a few weeks ago, we were going to be persistently in a higher nominal growth environment, I think investors are coming around to the fact that we're going to return to a low growth environment. And in a low growth environment, investors tend to look for those businesses that can grow and sustain in that environment, and many of those are in the NASDAQ.
NASDAQ 100 up for a fifth straight session marginally this morning by 1/10 of 1%. Jack, is the NASDAQ defensive? It sounds absurd because a month ago it also sounded ridiculous and the NASDAQ was still outperforming. So is it defensive?
What a weird world that we live in, John, where bad news is good news for so many market indicators right now. I mean, I would say you could play this defensively because at the end of the day, the NASDAQ is growth and it's technology, and tech is ultra sensitive to interest rates. And if you want to have a silver lining approach to all the chaos, all the mess of the last 10 days or so, it's that the terminal Fed funds rate this year is likely going to be lower than we would have expected post Powell's commentary last week. That net is good news for technology. But, John, the caveat here is that it's not growth at any price, because I don't think rates are going back down to zero anytime soon. So I would agree with Brian's sentiment earlier that quality is key, not only in the bond market, but also in stocks.
Jack, do we have to pretend that inflation doesn't exist anymore for this trade to work?
I don't think so, John, because, you know, if we're talking about lagging indicators, and I know that was sort of a theme of an earlier conversation, looking at that CPI basket, the shelter component, which is the biggest part of CPI, is a real lagging indicator. It just does not reflect reality right now. And if you look at what's going on with rental prices, they are starting to level off. We're seeing outright rental deflation in certain key markets like New York City. That's going to feed through very quickly into inflation. We already saw a 0.4 point drop from February relative to January. I think if we are patient just a little while longer, these numbers are going to get a lot better, a lot faster.
So, Brian, two issues. We talked about the NASDAQ and the outperformance in tech so far this week off the back of these monster moves in the bond market and the reduction of pricing out of Fed hikes, the pricing in of Fed cuts. Got all that. The other issue, Brian, that's come up repeatedly through this week are the guests that come on this program and talk about high-quality fixed income, investment-grade debt. And the question I keep asking, Brian, what is that? And can we get a little bit more specific? Because last week I can pick out some financial institutions that were also IG and now face existential risks.
Yeah, and you see it on the corporate side as well. I mean, when the banks are tightening lending standards, you're seeing corporate borrowing costs going up and spreads widening. So that's how these things typically play out. So you want to be a little cautious there. Obviously, you would favor investment-grade corporate bonds over higher yielding in this part of the cycle if you want to be more defensive. Now, with regards to treasuries and regards to mortgages, yeah, there's some banks that have been caught offside. Didn't hedge their interest rate risk, or just did not believe that the Fed was going to be as tight as they ultimately were. But for investors in their portfolios, John, not that long ago they were saying the 60-40 is dead. They were running out of the bond market, and what you find in periods of turmoil is that rates melt, and so investors looking at their statements at the end of this month are going to see that the bond component, the government bond, the high quality bond component of their portfolio held in quite nicely. Did perform very well during a period of volatility in the equity markets.
Brian, I just want to finish on this, looking at First Republic. It was halted after dropping pretty aggressively by 21%. It's resumed trading and it's down by more than that level now. Where are we? Down 22%. I've got the low of the week as 1750. We're at 2650 right now. Call it 2660. And as we've talked about already, Brian, this is developing even after 11 financial institutions in this country got together, banded together and put together 30 billion US to deposit in this institution, and yet still we face this as they suspend the dividend and face seemingly a real profit challenge as well. Brian, are we facing another one of those weekends where you're looking for a rabbit out of the hat before Asian trading starts, before we come back in Monday morning?
Well, it's possible. I mean, the one thing we see is that policymakers do stand ready to provide support if necessary, not necessarily to to save everyone, not necessarily to save the equity holders, not necessarily to prevent the bondholders from getting less on these things, but the reality is the policymakers stand ready to provide to maintain a functioning banking system. I think what investors have to realize is in a zero rate world, we had gotten very used to all financial institutions being able to maintain it. It's not as if historically we don't get into these challenges. Tightening cycles tend to end with shocks and crises. Most importantly for investors, though, and Jack had mentioned this earlier, this is not, we're not sitting on with banks with piles of worthless assets and we're waiting over the weekend to see how we're going to stem a contagion to the most globally integrated banks in the world. This is challenges that are very specific and nuanced to certain entities that were offsides for a much higher interest rate environment. So yeah, we may continue to look to see for signs from policymakers that they're going to provide support, but I would caution investors about extrapolating that to mean that this is going to be the next global financial crisis.
Hey, Brian, thanks for that. Brian Levitt there, Jack Manley. More constructive view at the end, more constructive view of developments so far. 13 minutes in, equities down 0.4% on the S&P. Coming up, Treasury Secretary Janet Yellen in the hot seat.
What is your plan to keep large depositors from moving their funds out of community banks into the big banks?
That's certainly not something that we're encouraging.
That conversation up next with AMH down in DC and Allsprings, Margie Patel.
every community bank, regardless of the size of the deposit, will they get the same treatment that SVB just got?
A bank only gets that treatment if the failure to protect uninsured depositors would create systemic risk.
Lawmakers grilling Secretary Janet Yellen over the government's response to SVB's collapse. Yellen defending the efforts, saying fears of contagion prompted federal regulators to act. For more, let's get to Anne-Marie down in D.C. AMH, what more can they do?
Well, that's a great question, Jonathan, and what a moment for the Treasury Secretary to be speaking to lawmakers under fire when you have this concerns in America about regional banks and, of course, the Atlantic issues with Credit Suisse. Her point yesterday was that for the regulators, number one priority right now is financial stability. But that moment there she had talking to lawmakers when she said that FDIC had to step in, concerns about contagion. That is the next question everyone has. Is this a precedent now that if there is contagion, the FDIC will be this backstop? That is a massive concern when it comes to these regional banks. And then, of course, today, if you look at what's happening with First Republic, questions is, was this enough? These big banks coming to the rescue of First Republic, of course, orchestrated by Janet Yellen and her colleagues herself.
First Republic right now down about 16 or 17%, trying to stage a recovery. AMH in Washington. Anne-Marie, great reporting, particularly on that meeting with Jamie Dimon and Janet Yellen just yesterday. That was from Anne-Marie here at Bloomberg. Margaret Bissell of Allspring, looking for a silver lining if it's out there. Here's the quote. The potential good news for the economy is that the Fed may stop raising rates and even consider the possibility of cutting in the near future. Margie, I'm pleased to say, joined us right now. Margie, wonderful to wrap up the week with you on this program. Let's start with this question. Have they done enough?
Well, they've certainly done more than enough damage to the financial system. They raised rates more than they have in history of any cycle, 4.5 percentage points in a year. And after we had a period from 2008 really through the COVID crisis of 21, the 2-year short rates are below 1%. So what do they think would happen to the financial system with this huge adjustment in short rates? The rest of the economy looks pretty good. Consumers, business, leverage doesn't look good. There's no sector that's out of line, particularly compared to 2008, the financial crisis. So this is a crisis of the Fed's making. If they would admit their mistake, what I think they should do is cut rates by 50 basis points and say, we made a mistake. We need to unwind the liquidity crisis in the financial system.
Margie, as you know, there's probably a lot of daylight between what you think they should do and what they will do next week. We're still debating whether they'll hike. This market's been all over the place. I know your remit leads you towards the equity market a little bit more now, Margie, but the bond market, you've seen this bond market develop for decades. Have you ever seen it trade like this, the way it has done over the last week?
Well, no, and no one has, because we've never had a financial crisis when the economy is in pretty good shape, and we haven't had corporates be over-levered, consumers be over-levered. That's what's so remarkable. We've had a run on the financial sector. They should bring back the uptick rule, and perhaps that might control these huge outflows that we've seen of speculative activity in the banks.
How's your equity market call changed over the last week?
Well, I've always felt since the Fed began raising that the risk to the market was the Fed itself, what the Fed would do. And once again, they delivered on that. And they now have a situation that's pretty unsavory as far as financials are losing relative strength. People are panicked, taking money out of the bank, really making the crisis worse. But underlying that, other sectors of the economy look good. Technology, industrials, materials, healthcare, and consumers all look very healthy. So if the Fed would stop damaging the economy, I think the economy could begin to stabilize. And I think we're in for a period of modest growth. Inflation on its own was already rolling over. So we just need the Fed to stand back.
And Margie, even if the Fed stands back, this is what people anticipate now. And I'll use the words of Michael Hartnett over at Bank of America. This is what people anticipate at the moment. Bank emergency borrowing will lead to tighter lending conditions, will lead to small businesses facing a credit crunch and higher unemployment. What's the argument, Margie, against that?
Well, the argument is if the Fed eased up, temporarily stepped back, lowered rates, you would see this financial indigestion in banks really, I think, subside. And you have to say to yourself, if you try to hurt the economy by raising unemployment, causing real damage to the financial system, what are you really accomplishing in this goal of trying to bring inflation to 2%, which clearly is out of their grasp to be able to do in the next year? The data have shown that.
Well, Margie, inflation's at 5 to 6. Again, it's not about what you think they should do, it's about what they will do. Given that we all expect they're going to hike maybe again next week by another 25, and people don't anticipate a big cutting cycle beginning anytime soon, why do I want to sit in places like industrials in the equity market? Why does that make sense to you?
Well, because if you can look past this temporary crisis, which is really not caused by fundamentals, it's caused by a dramatic rise in short-term rates and the Fed pulling liquidity away, now trying to pump some back into the banking system. The fundamentals of the U.S. economy really are too good to ignore. We've had big price corrections in lots of stocks, and so that says to me that if you can look over the next 6 months, the outlook for equities looks pretty good because the dividend yield is rising because of stock prices being lower. Price-earnings ratio is reasonable, and many of the sectors are in better shape than they've ever been, globally competitive. So it's a matter of being at the bus stop a little early before the bus comes. So I think it's better to stay in. And interest rates are really only providing a moderate alternative at this point.
Yeah. Got to avoid getting hit by that bus as well, Margie, just to extend the analogy just a little bit. Margie Patel there of Allspring, thank you. Equities doing okay, I guess. First Republic down about 16%. That is not great. Up next, your trading diary. It is going to be a long session for some of these banks. The Russell heavily weighted to the financials, struggling again, down a little more than 1%. The Nasdaq up for 5 straight sessions every single day this week, and the S&P down by 0.4%. As the price action, here's the trading diary. Coming up, the UMich Consumer Sentiment Survey, top of the hour. Looking to next week, US existing home sales out on Tuesday. ECB President Christine Lagarde delivers some remarks again too on Wednesday, the main event. Fed rate decision, Chairman Powell news conference, then the Bank of England follows on Thursday. From New York City, that does it for me. Good luck for the rest of the trading day, and if you can, enjoy the weekend. This was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, March 17th. Here are the top market stories that we're following for you at this hour. Stemming the bleeding, markets try to stabilize after a week of trauma as $2.7 trillion of options expire today. And First Republic's backstop. The bank gets a $30 billion show of support from a ton of big banks, while SVB Financial files for bankruptcy. It's liquidity versus insolvency versus confidence. First Republic stock still down 17%. So what do you do? Buy the dip, sell the rip? Bank of America says sell any rallies as Bill Ackman warns of contagion risk spiraling out of control. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, the biggest standout to me is any backstop that's been announced in the last week has not worked. If you looked at credit default swaps from Credit Suisse for the share price or the share price of First Republic.
Confidence has not been restored, and we go into a weekend where there are a lot of unanswered questions. What's going to happen with First Republic? What's going to happen with Credit Suisse this weekend? Are we going to get an announcement on Monday? We're going into a week when we've got the Fed. Who knows what the Fed is going to do in this kind of scenario? This all against a backdrop of economic data that is actually okay at the moment. I'm going to caveat that because we're getting data dropping onto the screen right now, which may show that the consumer is starting once again to have the jitters. We get the University of Michigan data. The University of Michigan headline number, the sentiment index, drops from 67 to 63. These are low numbers. Current conditions drops to 66.4 from 70.1. Expectations drops to 61, and one-year inflation comes down to 3.8 from 4.1. The five-year number dips a little bit to 2.8. Mike, 15% of the interviews for this data were done post-SVB, and yet the data drop as much as we are seeing right now. These are gloomy numbers. What should we make of them?
It's a very interesting question, Guy, because, of course, we saw a number of interesting economic releases during the time period, including jobs and the CPI. We've also seen some back and forth on the political front, and it's hard to know exactly how people are reacting. It'll be interesting to see when we get more data from the University of Michigan in their update about how Americans view the banking situation. A lot of people think, a lot of analysts think that, bank deposits are sticky. It may be something to worry about, but most people don't have more than $250,000 in the bank, so they're not going to be worried about losing their money, and they just kind of leave that in the background. But we know the White House has been very concerned about the perception of a bailout, so maybe there is a political aspect to this. But the good news is we certainly see inflation expectations anchored. That probably has to do with gasoline prices coming down a lot, and that gives the Fed more confidence that they are getting something done. Probably doesn't change the equation at all for next Wednesday, but at least it is a start on what is the Fed's long road.
Yeah, fair point. One-year inflation expectations down to 3.8%, 5 to 10-year around 2.8%. Mike, thank you very much. Really appreciate it. All right, let's get more insight here with the person behind the figures. Joanne Shu is the University of Michigan Surveys of Consumers Director. She joins us now from Ann Arbor, Michigan. Joanne, this is a totally unfair question, but what do you think these numbers are going to be once we factor in what's happened over the last 7 days and the banking system?
So almost all of the decline, actually all of the decline in the consumer sentiment index were realized prior to the collapse of SVB. And since then, the interviews that have come in have been fairly stable. Only a handful of them mentioned the banking crisis. And so this is pretty consistent with what we've seen historically in previous banking crises before the Great Financial Crisis and the S&L loan crisis. These bank failures weren't really at the top of the mind for consumers. But the news environment is very different now, and particularly with possible political factors around the perception of a bailout. I think it could be different this time, but it remains to be seen for the rest of this month.
Joanne, can you just crystallize for us how the data work here? How many, I said 15% a moment ago, how many of the interviews contained post-SVB information, and you talk about the interviews that done subsequently. Can you just kind of quantify the various blocks in which, from a time point of view, we have seen the impact of the banking crisis having an effect?
Absolutely. So in today's preliminary release, 85% of the interviews were conducted prior to SVB's collapse. 15% were collected afterward. And all of the decline that we saw in consumer sentiment occurred prior to the collapse of SVB. And so leading into the banking crisis, we were already seeing downward momentum in consumer sentiment. People are continue to be concerned about inflation in spite of the fact that expectations have ebbed a little bit.
Do you have the feeling that why are inflation expectations right now falling? Is it for the right or wrong reasons?
I think that inflation expectations are likely falling for reasonable reasons, but we shouldn't confuse the fact that they expect them to fall in the future with the fact that high prices still remain a big factor weighing down people's their personal finances. And so, you know, even if they expect things to improve down the line, it's still hitting people's pocketbooks where it hurts now.
Where would you expect, you break down the data in a number of different ways in terms of kind of how you are able to nuance what people are telling you. Are people expecting interest rates? Would you expect people to be telling you that interest rates are going higher as a result of the banking crisis, or lower? Or how would you expect this to fold in, this banking crisis, into things like, is now a good time to buy a new washing machine, etc.?
I think it's too early to tell in terms of any sort of interest rate expectation change as a result of the banking crisis. I think there aren't enough consumers paying close attention to that for that to move their interest rate expectations. But in the weeks ahead, we'll be able to see more. That being said, in terms of consumers' willingness to purchase, is it a good time to buy durables? We saw buying conditions for durables, autos, and cars all decline, or autos and houses all decline over March, primarily on the basis of high prices. And you know, regardless of whether interest rates go up or down a little bit next week, borrowing costs continue to be very high right now, and are certainly affecting people's decision making.
Well, based on what interest rates have done over the past few weeks, they've gone up and down a lot in terms of the massive volatility that we've seen. When we get the next read and we get more of the survey incorporating what's happened with the banking system, where do you expect that to show up the most?
I expect it to show up the most in terms of how people perceive credit conditions. And so if credit continues to tighten, and it tightens even more as a result of fallout from the banking crisis, that's certainly going to affect consumers' attitudes and their behavior. I think it's less likely to come up in terms of actual jitters around banks, the financial sector, and financial stability, because I just don't think people are paying that much attention to it right now.
What about business expectations?
Expectations for business conditions deteriorated this month as well. Every single component of the consumer sentiment index moved down, which is actually quite unusual. Usually there's a little bit of disagreement, but across the board, consumers see a mild worsening during the month of March.
This does not feel like a good report, Joanne. What was your overall takeaway?
I think consumers overall don't feel as good about the economy now as they did last month. I will say that in spite of the fact that everything moved together, they did move quite modestly. This was not a huge plummeting of consumer sentiment. We're still over 20% above the all-time low that we saw last June. And so consumers feel a lot better than they did last summer, but I think this is part of a bumpy road that is going to continue in the months ahead.
Joanne, always great to get the instant analysis. Thank you so much for bringing it to us. Joanne Shu, University of Michigan Surveys of Consumers Director. Coming up, John Kovalos, Macro Risk Advisors, Chief Technical Strategist, joining us next to talk about where we are at the end of this week. Wow, what a week it has been, and we are not done yet. This is Bloomberg.
Breaking news first.
Credit Suisse is a big deal. Too big to fail, but also too big to be saved. I'm wondering whether you would be assisting further. Absolutely not. We're not inclined to get into a new regulatory regime.
The Swiss National Bank would provide liquidity if needed.
Increase the three key ECB interest rates by 50 basis points.
First Republic down about 30%. We're on watch negative for Western Alliance.
This is the tip of the iceberg. For the latest on the banking industry turmoil, keep it tuned to Bloomberg TV and Radio.
You end up yet again in the muddle middle. You end up yet again flip-flopping. You end up yet again with inconsistent communication. But this Fed, I suspect, will be inclined to do this. I hope they don't, but it wouldn't surprise me if they're inclined to do this.
That was Mohamed El-Erian, Bloomberg opinion columnist and University of Cambridge Queen's College president, earlier on Bloomberg TV. What do you do right now? That brings us to the question of the day. Do you buy the dip or sell the rips? And in that way, the market has been very confusing in how it's moved. Help us to answer it, John Kolovos, Macro Risk Advisors, Chief Technical Strategist. And I just want to start, for example, on the S&P. It's sitting right in between its 100-day and 200-day moving average, despite all the headlines, despite the drag from First Republic, despite the drag from oil. How does this make sense to you?
Yeah, well, thanks for having me and happy Friday. Well, how does it make sense to me? Well, this is something that we've been talking about, writing about, is that we're in this technical torture chamber, right? Where the market is just stuck, essentially going nowhere for the past, 6 or 7 months. And the reason being is there's no feedback loop for the market to embrace, whether it be an upward trend or a downward trend. So, and this is also characteristic of what a torture chamber is. The narrative will change almost daily. It's an incredibly frustrating environment. Breakouts don't work. Breakdowns don't work. Nothing works. Essentially, you're just stuck in this period. It's torturous.
So you probably need to get a little bit more specific, John. Good morning, it's Guy. The banks are obviously at the epicenter of the action. The regional banks are at the epicenter of the action. What are you seeing there?
Okay, yeah. So let's talk a little bit about the regional banks. So with the regional banks, and I could use this also in your neck of the woods by looking at the European banks, but they're topped out. I think they're dead money for the time being. At least that's what the charts are suggesting to me. How much downside could there be? Well, the charts are pointing to could be a 10, 15. I won't even go so far as say 20% downside risk, but it's possible. So with the regional banks, trend is positive from 09, but look how much runway there is between this week's low and that trend line support. There's quite a bit there. And then the last thing I would say about that is, let's just assume this was the low. If you look at how banks bottomed, and most industries bottom after a crisis, a period of neglect is needed. It could be 6 months before we see any meaningful upside for the banking sector.
What does that mean for the 2-year then? Talk about breaking below some support levels.
Yeah, well, that's the thing. So last week was the quickest reversal in its momentum, right? Going back to even the 87 crash. And the question I have is, and this is really what's most important to me, it's not the speed, is whether or not a trend reversal is happening. And the way I'm interpreting the chart of the 2-year yield is that, yeah, it's topping out. Getting underneath that 4% level is an important change in market dynamics, and it actually implies a move lower in rates to about 3%. So I'm a buyer of bonds on the short end, and also to a certain extent on the longer end as well.
What's your degree of certainty around that, John? And this is an option to move on to talking about the MOVE Index and what's happening with bond volatility. But what is your degree of certainty around that? We're going into the Fed next week. The ECB just raised rates by 50 basis points. I have no idea what the Fed is going to do. Mohamed El-Erian was just addressing that issue in the clip we just played. We are going into even more uncertainty surrounding the 2-year with the Fed coming up. So how easy is it to make this call? I see what you're doing with the charts there.
Yeah.
But is this a difficult call to make?
Nothing's easy in this business, Guy, right? It's incredibly difficult, but what I have to follow my process, right? I'm a chartered market technician. I have certain steps and processes that I follow in terms of identifying whether or not a trend reversal is occurring. You're breaking moving averages, you're making lower lows, you have a pattern that's developed here. I got to follow the process. So I'm relatively confident in that view that they have topped. But where am I wrong? Where is the market expectations wrong? I would say if the 2-year finds itself back above 4.5. So until that happens, I follow my process and be prepared for 3%.
Hey, John, we're looking at a fixed income trading volatility exploding. You're looking at crude, you're looking at FX, and you're looking at fixed income. Does it stay that high? Does it stay that decoupled from its peers?
That's the question. That's the question whether or not the S&P is going to make a lower low, right? That's kind of the question I'm getting from clients. Do we have to start thinking about 3,200? And my answer is, well, it depends on the other cross assets. A move at 200, that's like a VIX at 60. So let that sink in a little bit, right? That's what the fixed income market's going through right now. But look at the other currencies, the other cross assets. The currency vol, kind of moving up but not too much. The oil vol, that's catching my eye. That's starting to climb. Once all cross assets implied volatility start to climb, that's a sign of macro uncertainty. And risk assets don't like macro uncertainty, and that could very well transition the S&P from a sideways range into a downward trending market.
You bring up oil. I feel like I'm asking Alex's question here. What's happening with crude? Alex has been talking all week about the fact that we're at key levels right now. Talk me through the levels that you're seeing and are focusing on.
Alex is absolutely right. Key levels. My longstanding view is that oil had to correct down to $65, right? We're pretty much there at this point. Why is it an important level? We'll go all the way back to COVID, right? Those are the COVID highs. Could it get down to 60? Yes. That is the lowest I'm willing to allow the chart to deteriorate to. Under 60, then I think a whole paradigm shift is going on here, and the market's going to start thinking more and more about recession and the spillover effect of what's going on, not just with the banking crisis, but then the Fed's ability to fight inflation in this environment. So 60 is the level of levels it has to hold there. Otherwise, then that previous chart I showed you with volatility, everything's going to probably start exploding up higher. And to my point of, do we have to start worrying about lower lows in the S&P 500? This is the next thing to watch. We already have the move on the move index, but now the next, the commodity complex is also going to explode.
Javier Blas had a really great piece out talking about the fact that a lot of this is going to be paper moving because a lot of huge companies and huge countries hedged at certain levels, and now you got the other side having to rejigger everything. Anyway, before I let you go, John, something that's been really interesting is the outperformance of tech, and I have a really hard time understanding how we can consider tech the safety trade right now.
Well, what's interesting, I guess it's the quality question, right? So on a market neutral basis, the quality factor is at a new high. So the market perceives these companies, the Apples and the Microsofts of the world as quality and safe havens. And that's kind of what kept the S&P afloat, right? It's that push-pull. The financials are getting crushed, but then the tech's pulling it. Once the market starts thinking and feeling that, even Apple's not safe, then the S&P could actually roll over. But it's just a math equation. The S&P is still too much geared towards mega caps. Still has that problem.
And the playbook has been for the last 10 years, you get rates down, you buy tech. It's been a narrative that has continued and continued and continued. But as Mr. Harnett over at Bank of America is saying, you're looking at this the wrong way. The way you want to be looking at it is this is signaling a recession is coming, and that's a very different playbook. John, great to catch up. Thank you very much indeed. John Kovalos, Macro Risk Advisors, Chief Technical Strategist. Thank you very much indeed. Have a great weekend. Still ahead, Silicon Valley Bank's parent company files for bankruptcy. Have we seen this problem in plain sight for a while? We're going to talk about the details around all of this. The startup is coming up next. This is Bloomberg.
I think yesterday's action by 11 of the largest institutions in our country to put money in First Republic wasn't only a show of support for that institution, but for the entire banking system by the largest banks in our country to demonstrate that our system is safe. And while we're going to remain vigilant, ultimately our goal in this administration is to make sure that the depositors are safe.
22 minutes past 7, nearly 23 minutes past 7 on the West Coast. It is time for the startup. Looks like it's going to be a lovely day in San Francisco. We're going to cover the top tech stories from the Bay Area and beyond. Silicon Valley starting another morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. Ed, I want to talk about SVB, parent company filing for bankruptcy. Yeah. There's a great story on the Bloomberg talking of the weather, saying that there's been a cloud hanging over this company for quite a while. This has been a problem that has been hiding in plain sight.
Yeah, I mean, astonishing morning. The basics of it are that SVB Financial Group, which was the parent company of Silicon Valley Bank, has filed Chapter 13. Really important to point out that Silicon Valley Bank, the bridge bank, Silicon Valley Bank NA, is not impacted, right, because it's a state-chartered bank, and also under the receivership of the FDIC, it cannot technically fall or file into bankruptcy. So they're two separate entities, but in time, the relationship between the two really interesting. Our colleagues around the country here reporting that 1 year ago, the San Francisco Fed appointed a new team to go into Silicon Valley Bank a year ago, and they quickly found shortcomings in everything from the technology that the bank was using right through to its risk assessment on the current interest rate environment at that time. The plot twist that one of the appointees left in 2021 to go to none other than Silvergate. You can't make it up. Really incredible story on the Bloomberg, which you must read.
Yeah, that was a must-read, Ed. And I left with some more questions, though, because it seems like the Fed was alerting the banks to the issues, and then I don't know what the next statement is. Did the Fed then not follow through? Did the banking team ignore it? Did the company ignore it? What do we know?
We have the pledge from Jay Powell, right, that there will be a very serious look at what happened at Silicon Valley Bank and the findings of that look to come in May. Essentially what we have reported, citing sources, is that these assessors from the San Francisco Fed, as recently as the end of last year, had contacted management to say, you have to address these shortcomings. And in time, we'll find out what that means. But remember the other reporting, Founders Fund, who we reported were the first VC firm to pull their own capital last Thursday, a week ago on Thursday. When one of their partners, Trey Stevens, came on the show with me earlier this week, he said that they'd known for a matter of weeks, if not months, that there was something wrong at Silicon Valley Bank. They did not just find out the night before when that share offering came in. So, yeah, history will tell us, right, what's happened.
Yeah, that's an unbelievable statement. Anyway, we're taking a look at that as well. First Republic, we'll talk about that later on in the show. You're looking at First Republic stock down 20%. We've already seen all the halting despite $30 billion worth of commitments from other big banks. Ed, great stuff. Looking forward to your show at noon hour here in New York. Bloomberg's Ed Ludlow joining us. So coming up, oil is on track for its biggest weekly decline in nearly a year. RBC says it is sending 2008 recessionary vibes. We're going to take a look at the broader commodity market. Is a shipping company on the ground really seeing this reflected? We're going to talk to John Woban-Smith, Genco Shipping CEO, joins us next. This is Bloomberg.
About that all day yesterday.
And we're about an hour into U.S. trading session, so guys, get ready. We're now flipping all the major indices into negative territory. The Nasdaq 100 was a holdout, but now that's down by about 0.1%. Abby's tracking all those moves. Abigail?
And these declines, Alex, it's on big volume. The S&P 500, the last time I looked, 200% above the 20-day average in terms of the anemic volume that we had. So the selling is on real news. On the week, we are looking at gains, though, at least for the S&P 500 and the Nasdaq 100. But clearly, where we're not looking at gains, the banks, the fallout from the Silicon Valley turmoil, the collapse really continues to weigh on regional banks. And First Republic down 19% after rallying yesterday. That backstop, that $30 billion backstop from JP Morgan and other banks. Yesterday, it helped confidence, not so much today. There's fears. So, of course, with fear on weighing on the minds of investors, we have the Haven bid going back on. This is incredible. If we take a look at the 2-year yield over the last roughly 7 days, it's incredible. It is down more than 1%, and that's not even at its lows. To see that kind of move in such a short period of time, it's a repricing of risk of a type that I don't think I've ever seen during my career. And it's certainly shifting in terms of the sectors that folks are going into, because on the week, it's not all bad. If we take a look at the Nasdaq 100 and the communication services, some of those mega cap tech sectors, this is what we're looking at. Huge gains. So the Nasdaq 100, the best gain since November of last year. As yields go in, the valuation looks more attractive. Plus, if you recall, during the pandemic, tech was considered to be a haven. Take a look at the crypto space. Not the haven I would expect, but you have Bitcoin back above $26,000 per Bitcoin. We also have Coinbase sharply higher. So who knew? This is an interesting dynamic. Where we're not having gains on the week, though, in fact, oil heading toward its worst week in almost a year. Take a look at this chart of oil, because it suggests that we may continue to see declines if oil stays below this range. You could even make the case that this range is already truly breaking to the downside, targeting another, let's call it $10 to $15 lower, potentially below $60 in the near-term guy on the fears that maybe a recession is ahead. Or in the other case, with the yields coming in, the idea that inflation, there's less pressure, maybe the similar deal with oil, but oil is a risk asset, so hard to balance out all these different factors, Guy.
Absolutely. The tech thing I'm finding a real head scratcher right now, but I guess yields down, tech up, maybe that does still work, but the question is for how long. Abigail, thank you very much indeed. We've also got an expiry today, which is worth folding into the narrative that we're watching. So this is a story that we've been watching throughout the week. RBC, Alex was pointing this out to me a little bit earlier on, out with a note this week saying WTI retracing to the mid-$60 per barrel level is what our models peg as fair value for a meaningful 2008-like recession. Headlines of the past week draw eerie parallels to the early days of the great financial crisis, but the latest market retracement feels overdone. Cheery words to wrap up on a Friday. Let's look at what this says for the rest of the commodities market right now. John Woburn-Smith, CEO of Genco Shipping, joins us now. Genco, one of the largest dry bulk shipping companies in the world, so doesn't move oil but moves pretty much everything else. John, great to have you on the program. We are getting huge volatility, huge swings in financing, huge swings in asset markets like we're seeing with oil. How does this translate into what you're seeing right now? The market is a little spooked. What about the shipping industry?
Well, the shipping industry, dry bulk anyway, is very healthy. So what we've actually seen over the last 2 weeks, even though the equities have gone down, vessel values have gone up, freight rates have gone up, and it's all on the back of China reopening after the COVID lockdowns, as well as the beginning of the stimulus programs that have been put into place starting to kick in China.
Do you see any recessionary signals in the stuff that you move?
We're not seeing, so if you look at our major commodities, iron ore, that is our number one, and 75% of that iron ore goes into China. And we have seen the price of iron ore firm. We're back up to $130 a ton. We've seen the price of steel in China rise. We've seen inventory levels move down, meaning there's real demand in it, and it's being used. So what we're seeing in terms of major commodities is actually strength on the dry bulk side.
So I was at CERAWeek last week, and speaking to people there, they say the same thing, that the West has an interpretation of China not actually being that strong. But literally, the closer you move east and the closer you move to China, the stronger the demand that you see and the stronger the demand pull there. What's your level of confidence of that demand pull?
Highly confident. I mean, we're already seeing, we've seen the 5% GDP target set. And I would argue, I know there was disappointment around that, but I would argue that's a floor. I actually think you're going to see a surprise to the upside as we get into the second half of the year in China. Let's also not lose sight of India is a major importer of commodities as well. And India's economy has been doing very well because of all their infrastructure building also. So everything that we're seeing in Asia is looking very positive. And, I think we're once again seeing China decouple, from the world economy. We saw this during the global financial crisis, and we saw this coming out of when the West was coming out of COVID in 2020.
John, does that decoupling work when we see lending standards start to tighten up in the West? That is the big concern right now. That is the read across potentially out of the banking crisis into the real economy. Do you expect that to happen? This is an industry that is quite leveraged to current financing rates. What do you expect to happen on that front?
Well, let's also keep in mind that, the dry bulk industry has been healthy over the last 2 years. So not just Genco, but some of the other companies have delevered pretty significantly. So not a lot of interest rate risk, at least for our company. What I would tell you is while we're all very much focused on a potential recession in the U.S., from a dry bulk standpoint, the U.S. is actually exporting corn, wheat, and soybean. And there is plenty of demand for that. And then really the only commodity that we bring into the U.S. is cement. And cement is basically sold out right now, even though we're in this sort of recessionary environment.
How long is your visibility for stuff like that? Like, is it 6 months? Is it 3 months?
Yeah, I would say it's 3 to 6 months is what we're seeing. And, we're as the market has started to move back up in dry bulk, we're starting to fix out 3 months, 6 months out again.
Just to kind of stick with this for a moment. Yeah. What signal do you take from that cement story? Because it's really interesting. In the States at the moment, you've got this banking story that is developing. You've got a consumer that is wobbling a little bit, judging by the data that we've just seen at the top of this hour. But if you take a look at some of the other data, for instance, some of the nowcast data on what GDP is delivering at the moment, it looks really positive. John, do you think the U.S. is anywhere close to a recession? How are you thinking about it from an economic point of view?
Well, like I said, again, the cement trade is a decent-sized trade for us. I would still call it a backhaul trade in that it's coming from the Middle East area and into the U.S. But we also have to keep in mind we still have these infrastructure bills that have been put into place over the last couple years, and that is primarily what is driving that cement business and the spending.
That's interesting. So that's like the transportation. It's all, and it's also going to be the IRA. On a broader level, I'm wondering if we're all looking at inflation and how fast it can come down. And I've been hearing a lot about how the trade routes have been completely disrupted from the war in Ukraine, and that's more of a structural issue. So there's no efficiency anymore in the trading routes, and that's all going to cost more. What are you guys seeing?
Yeah, so we've seen a big disruption in the coal trades because of Europe not importing coal from Russia anymore. So they are having to import it from South Africa, Australia, Colombia, even the U.S., longer trade routes. That has pushed up shipping rates and created inefficiencies. And then on the grain trades, while the Black Sea has really seen their grain trade cut by about 50%, Brazil is having a very good soybean season, so the Chinese are now buying a lot of soybeans from Brazil. The U.S. should have a decent corn and soybean season as we get into the late summer of this year. So again, longer trade routes. Instead of the Black Sea having grain go into Africa, Africa is having to import it, again, from longer trade routes. So the whole minor bulk and coal system has been disrupted. It's created inefficiencies, and freight rates have risen.
John, the Black Sea Grain Initiative, which is allowing the export of Ukrainian grain, I think expires tomorrow. Yeah. I think there's been a suggestion that maybe it gets extended for another 60 days. What do you think is going to happen? What are you preparing for?
Well, I mean, it's interesting. The agreement itself allows for a 120-day extension, but we heard as late as yesterday that the Russians are really focused on only a 60-day extension. Very confident that's going to happen. We'll have to see how much further it goes from there. What is happening though there is a large number of ships that are held up for inspections there. The number of inspectors that are physically available has shrunk pretty drastically. So even just looking at August, September of last year, maybe you had 100 ships that were in congestion. That is more than doubled.
Wow.
There are a lot of ships that are sitting there, and it's mostly going in where you have the real holdup on the inspections.
On a day-to-day business for you, how stressed is your CFO now? And I mean, like, that doesn't create a lot of visibility. Trade routes and the type of ships you got to use have changed, and then you have the massive volatility in rates. And shipping is such a heavy cost of capital business. Like, you rely on a lot of funding, and I know that you've been paying off a lot of debt. But what's liquidity like for you guys? Are you worried?
No, we have literally
But if rates can still stay volatile,
and they have been. They've been volatile. I mean, let's think about this. When we got into the first quarter, Capesize rates, which are the largest ships, they solely focus on the iron ore, a little bit on the coal trades. Those rates got down to $3,000 a day, which is below cash flow break even. Now, our company had fixed a lot of the first quarter already, so we didn't really have exposure to that. But those rates now have gone from $3,000 to $16,000. And if we look at the forward curve towards the end of the year, those rates should hit 22, 23,000. I would argue they're actually going to go higher, but that's what the forward curve is showing right now, which is really pricing in, again, a Chinese recovery on the back of their steel industry and consumer demand.
And that offsets the volatility in, say,
yeah, the volatility is not going away. I mean, it is always like this. But what we try to do is fix through that volatility and take a lot of that off the table.
Hey, John, it was really good to catch up with you. Guy and I are just talking about in our show chat how much we like talking to shippers. Genco CEO John Wobensmith, thank you very much. Okay, we do have some breaking news for you concerning Turkey. Of course, I forgot, and I have to pull it up on my terminal. Give me a moment. Turkey will ratify Finland's NATO membership, and this comes from President Erdogan. Erdogan says that Finland took concrete steps on pledges, and Turkey's been a defender of NATO's open door policy. They will be ratifying Finland's NATO accession. That is the latest, and those ties, of course, then between Turkey and Finland will be reinforced. All right, coming up, First Republic shares slumping despite the rescue package. You got Charles Schwab also seeing tons of outflows from money market funds. More on all that banking turmoil next. This is Bloomberg.
Keeping you up to date with news from around the world. Here's the first word. I'm Lisa Mateo. The earthquake that shook Turkey's southeast last month caused nearly $104 billion in damage. That's according to a report from President Erdogan's government released days before the European Union holds a conference to aid the reconstruction effort. It calculates the toll on the economy at the equivalent of about 9% of this year's gross domestic product. The 7.7 and 7.6 magnitude tremors and their aftershocks killed more than 50,000 people in Turkey and Syria. The UK government and education unions agreed to begin intensive talks in a bid to end a wave of teacher pay strikes. 4 unions in the Department of Education say no school strikes will be announced for the 2 weeks while the discussions are happening. The move raises hope of an agreement to end industrial action in schools across England 1 day after the government reached a pay deal with nurses and ambulance workers. And Charles Schwab saw $8.8 billion in net outflows from its prime money market funds this week. Investors are rattled by turmoil at U.S. banks and plowing even more money into the brokerage's assets with government backing. Company data compiled by Bloomberg shows clients pulled money from 2 Schwab Value Advantage money funds, which had a combined $195 billion of assets as of March 15th, representing the largest redemptions in at least 6 months. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Alex.
All right, Lisa, let's kind of wrap all this in here. Let's get more on the bank turmoil, specifically what's happening with First Republic. Bloomberg's Shilani Basak joins us now. It felt like yesterday was going to be a huge gift box to First Republic in the market, but then the stock is still lower. And I don't understand how this is going to wind up playing out.
Yeah, it was pretty amazing to see. The immediate support had buffered the market, but then that lifeline only really lasted to appease investors at the very least for less than a day. And I think that this is important here because the structure of the bank-led rescue package here is via deposits. It wasn't meant to dilute any of the investors. I think actually the bond market is telling you a lot of signals because you see First Republic bonds really trading down. When I talk to a lot of bond investors, they're saying, like, on one hand, this is an opportunity of a lifetime to be buying up these bonds and even the equity at a pace like this. But the end game here is the massive question. Does this ultimately lead to a sale because the door has been left open for that? But until that there's some clarity around, you know, how much pain there is under the surface, these are very hard questions to answer.
Shilani, isn't the reason we've done what we've done, or the JP Morgan-led initiative has proceeded in the way that it has proceeded, because none of the big banks can buy this business because of the scale that they already have? Who could buy this bank?
Listen, that's the greatest question, Guy, because if you look at what's been happening here, what I'm hearing under the surface is right now, when you look at the biggest of the big, the JP Morgans, the Bank of America, there's kind of a deposit cap, so they would have to be waived here by federal regulators in order for something like this to happen. They do typically get waived in crisis-era deals, but then the smaller firms that would really gain from attaining an asset like this, do they have the financial heft to do that? That is the other big question. The third question here is, what does the deposit flight look like currently? Because if you're a large bank, what I'm hearing is, okay, if you're not going to create the next JP Morgan Chase, is a deal like this worth it? Do you acquire the bank or do you acquire the customers? And are all the assets attractive? Listen, when you look at what's happening now, it took a full week before the Silicon Valley Bank parent company here, SVB Financial Group, has filed for bankruptcy. They tried really hard to find buyers. And the reality is not all of these assets were really attractive to the market, and that's why we find ourselves here.
You said Guy asked the greatest question. I don't know about this anymore. Shilani, thanks a lot. Really appreciate Bloomberg Shilani Basak. Yeah, I mean, come on now. All right, that brings us to the question of the day. Do you buy the dip or sell the rip? So let's talk about what ETF investors are doing and how this crisis is spilling over. Bloomberg's Katie Greifeld. Katie, it feels like the conversation has been trillions of dollars worth of assets are being reshuffled right now. What are the flows telling you about where it's going?
Let's go straight to SPY. This is the world's biggest ETF that tracks the S&P 500. Yesterday, investors investors added $7.3 billion into this fund. That is the largest one-day inflow since November 2020 when we had that initial COVID vaccine announcement. So people clearly buying the dip in some sense, but then you look at what's going on with money market funds, also seeing a huge influx this week, the largest since April 2020. So I think that's a really interesting dichotomy you have going on here. People looking to buy the dip in stocks, and I will note the S&P 500 is actually higher this week by 1%, but still a lot of appetite for cash.
Katie, are these two different things, though? People are moving money into equities because they think rates are going lower. They're moving money into money markets because they're worried about the banking system.
I mean, it's a good point that it's not binary when you think about how people actually allocate their money. And there is a lot of talk that we could be heading into either the last hike of this cycle or we might see the Fed pause altogether. So that would benefit stocks theoretically, especially those big tech stocks that have such a high weighting in the likes of SPY. And at the same time, I mean, if you want safety money markets, we know that they're yielding more than they have in a very long time. So it's not a bad place to also park your cash, get some safety there as well.
Yeah, just ask Charles Schwab, because having to meet all those redemptions and put it elsewhere, I would get very confusing. We've seen massive volatility in the bond market, even today the 2-year now down to 20 basis points. I mean, these are humongous moves. What's the knock-on effect for Treasury ETFs?
I mean, the fact that you're seeing this kind of volatility in treasuries, short duration treasuries, I mean, this is one of the world's safest assets. This kind of volatility for the ballast of your portfolio, not great. When you look at the flows, you haven't seen too much. I mean, you're still seeing a lot of flows into those ultra short duration 1 to 3 month treasury bills. When it comes to the 2-year, the regular short duration funds, not as much love. I will say you are seeing some appetite for the likes of LQD, HYG, corporate credit, seeing a little bit of a bid here, even though we do have some more fundamental worries like we haven't had in a little bit now.
Katie, what about banking ETFs? In theory, you would think logically money would be coming out of them. Is it?
No, that's the thing. If you look at KRE, which has really been the epicenter of all of this, this is a regional banks ETF. Typically, we don't ever talk about this ETF, but really over the past week, it's become the center of the action. You've seen over $1 billion come into this ETF. You've seen volumes hit a record high, both in regular trading activity and when it comes to the options market. So money is still coming into here, and it looks like people are trying to buy the dip here. But when you talk to the likes of Bloomberg Intelligence, when you talk to Citi analysts, a lot are making the point that a lot of institutional players are playing this from all sides. It's not necessarily just a directional bet. When you look at what's going on in the options market, they're using it as a hedge as well.
It's amazing. Such a fascinating story, completely counterintuitive, but as you say, maybe people are playing the other side as well. Katie, fantastic stuff. Thank you very much indeed. Of course, you can catch Katie and all the latest ETF news, ETF IQ, every Monday, 1 p.m. New York time. This is Bloomberg.